Down in China may worsen thanks to poor asset quality in Chinese banks. What's the warning that's coming in from both the International Monetary Fund and credit rating agency Fitch? What's worrying for India, however, is that if mishandled, this delicate situation could spill over into other emerging markets. CNBC TV 18's Alexander Mathew gets you that story.
Chinese banks say their cumulative non-performing assets stood at 1.27 trillion yuan or $195 billion as of December 2015, the highest level since June 2006. But the IMF and international ratings agency Fitch Ratings seem to be taking this number with a pinch of salt.
In China, what we know is that reported non-performing loans are very low. They are lower than 2% of loans. And if you add the so-called special mention loans, the overall thing is below 6% of total loans.
So the IMF believes that deleveraging to the extent of 25% of China's GDP must take place, and any mishandling of this could mean pain across the globe.
If the management of the leveraging and the reinforcement of the position of banks happens in a way which is a good one, and then things, function well, I think that that would lead to more certainty about China, and the spillovers would be positive throughout possible channels. And if not, if there are bumps and the bumps are big, there would be spillovers.
India, however, may not bleed as profusely as other emerging markets.
The direct exposure to India from a China slowdown is, in our view, fairly small. The impact is more elsewhere in Asia, and that is because of the linkages of growth to those markets. So a slowdown in China has a knock-on impact there. India clearly has a much bigger domestic market, and that's a key driver to economic growth.
However, both IMF and Fitch stress that whether insulated or not, India must continue to address the stress emanating from leveraged corporate balance sheets and poor asset quality in public sector banks. In Mumbai, Alexander Mathew.